You're welcome to the online class. We are still on ACC102, Elements of Bookkeeping 2, Unit 3. Okay, in the earlier videos, I have done a series on Unit 1 and Unit 2. So if you have not seen those videos, you can check my channel. You are going to see those videos there. And if you are here to subscribe, kindly subscribe so that you continue to enjoy more videos from me. We want to look at Unit 3 today, accounting concepts. Starting from key accounting concepts. Accounting concepts can be defined as broad basic assumptions that underlie the periodic financial statements of business enterprises. So they are basically assumptions that guide us in the preparation, interpretation, and usage of financial statement. Let's start with the key one, perhaps the most important concept, that's the growing concern concepts. All right, so that is the assumption that an entity will continue in operational existence for the foreseeable future. So you don't prepare financial statements in such a way to deceive people or to mislead people that the organization is going to be existing for the foreseeable future. So there is that assumption that when we pick a financial statement, the company that the financial statement has just been produced, that company will be in existence for as many years as possible. Okay. So if that is the case, then you can use historical cost basis, all right, in preparing financial statement or the fair value. Okay, but if you have clear evidence that that company might wind up, will wind up within the next 1 year, so you have to use the net realizable value, okay, or breakup basis to prepare the financial statement, so that we actually, we know we are going home. So everything is at the, at the disposal value. Okay, so that is the what we need to take note here in this big concern concepts. There is a basic assumption that the financial statement you are preparing is for a company that will exist into the foreseeable future. Okay, then you have the accrual concept. So you have accrual concept is the basis that the assumption, all right, or the acts in which financial transactions are recorded in the time they occur, not when they are actually paid for, all right, or there is an exchange of cash. Okay. So if, for example, the company consume electricity for 2021, but they've not paid. Okay, so it will be very misleading because you've not paid for the electricity and it's not appearing in your books. All right, so it has to appear as accrued expense because the expense has been incurred for that period. Okay, the same thing for revenue also. You also have accrued revenue. You have not collected the money in cash, but you have done the job. The job has been delivered, the goods have been delivered, or the service have been rendered. So because of that, you have to recognize the income also in the financial statement. That is basically what we mean by accrual concepts. Then we have matching concepts. So matching concept is very closely related with the accrual concept in that we must match revenue and expenses together so that we can have the true picture, okay, of what happened in that organization, okay, for that year. I just give an example of 2020. Okay, so we did all our sales in cash. So we got all our revenue in cash. Okay, so we have revenue to also our amounts. But some of the expenses we are able to negotiate our way out, and some of those expenses were incurred in credits. We didn't pay cash. So which means if you match revenue cash against expenses cash, you will have misled the users of the financial statement. That is what that means. So you need to be able to match the revenue in cash with the expenses in cash plus the expenses in credits. That's what we call accrued expense. So that the users of the financial statement can actually know exactly what occurred in that financial year as per revenue and expenses. That is what we mean by matching concept. Then we have entity concept, all right, which is also known as accounting entity or business entity concept. So the idea is that the owners of the business, they are separate entity from the business itself. So that is why when you are doing accounting, right, you have to be very careful so that the personal expenses of the owners of the business are not captured in the books of the entity itself. Okay, materiality concept. Okay, so the idea is that you have to record only what is material to an organization. You don't want to litter your modeled up with the statements, financial statement with all manner of irrelevant amounts, you know, ₦1 transaction for a bank, all right, or 200 naira transaction, you know. So somebody took a bag, 100 naira, 200 naira, aggregate them together. Let's okay, local transport, add everything together so that it can make sense. Okay, so materiality concept affects every transaction, all right, and every set of financial statement. So this concept assumes that only material items should be disclosed in the financial statements. Okay, time period concept. So that one basically means if you are going to report financial statement, you must define a period. Most of the time is 1 year, annual financial statement, or you may have a semi-annual, you may have quarterly, depending on your organizational policy. But at least for the audited financial statement, you should do that at least once a year. Historical cost concept of fair value. So when you are going to record financial transactions, or according to IFRS, okay, you IS1 this time around, International Accounting Standard 1, okay, you are to record the financial transactions on historical costs. All right, so that is how much did you actually bought the asset, all right, or how much did you earn, okay, exact amount, okay. So historical cost, basically how much was exchanged in naira or in kobo or in whatever currency, actual price, all right, bill, revenue charge. But you know, sometimes after some time it might not make sense again. For example, you bought a building or a land, a piece of land. In Lagos, some land, those days, maybe people that bought Lagos land in the 70s. Okay, people that bought Lagos land in the 70s. Can you imagine how much they paid? So if you have a company existing in 1970, for example, and bought a land in Lagos, okay, so you can imagine how much how it's going to you know the price, how material the price is going to be now. Okay, but let's even say 1980. Okay, 1980, maybe you bought a land for 5,000 naira. You know, then maybe around the Apapa site in 1980. So imagine how much that land is going to be now. So it's not going to work. It's not going to make sense to retain that as at that value. So you have to use fair value. So fair value means you are giving us, all right, the amount for which the assets can be exchanged or liability settled between knowledgeable willing parties in arm's length transaction. That is IFRS 1. Okay. Definition. So fair value, basically, forget about the big English. It's just actually market value. All right, market value that people that are knowledgeable, both the seller and the buyer, will agree that this is the market value of this asset. That is what we mean by fair value. So you have a choice use historical cost or use fair value. The money measurement concept. The money measurement concept allows the user to assume that the performance and financial position of a reporting entity will be expressed in monetary amounts. So usually in the currency of the country where the business is registered. So as financial accountants, we record transaction in naira, in cedis, in dollars, in yen. So it has to be in monetary term. That is basically what money measurement concept is all about. Okay. Then you have duality concept. It's also called double entry. So what that means is that for every transaction, there are two legs, like we say in accounting. So you have a leg, you have a debit entry, you have another leg, credit entry. Okay, we'll talk more about that when we are looking at accounting equation. Okay, so every transaction must have two entries. Okay, I bought furniture and fittings with cash. Okay, asset of furniture and fitting has increased. So I debit my furniture and fittings asset account. Asset of cash has decreased. So I will credit my cash account. So you can see one transaction, two entries. Okay, the prudence concept. So just like the name implies, prudence concept means you should be prudent. Okay, so don't overestimate money that is not yet in your hands. And don't underestimate costs that have not yet actualized. So that is prudence. So you will, as you go higher in accounting and you are doing calculations, especially in provision determination, how much you will provide for, right? There is a court case that might lead to financial penalty for the organization. The prudence concept says if it is going to be an outflow of financial resources, it's better you look at the worst case scenario, all right, to be on the safe side. Okay, and if it's going to be an income and you're not yet sure, it's better you underestimate the income than for you to overestimate the income and your estimation did not work again in real life. So basically, that's what prudence concept is all about. Substance over form concept. All right. So the idea behind substance over form concept is that you don't get carried away too much by legality. All right. This is what the legal form should be. All right. So there are some, for example, in law, they will tell you a contract is could be enforced or could be sealed either by writing or even orally. Okay, so there are some contracts that by conduct it is clear that both parties have agreed, through their actions. So substance over form says your accounting practices, all right, should not be too bogged down with legalities, all right, dotting the I's, crossing the T, what happened? Okay, substance over form, what happened? Has values been exchanged? Yes. Okay, they paid the land, they have exchanged land, so a party gave away a land, the party paid money, settled. So values have been exchanged, transactions have been done. So substance must always be recognized by the accountant over legal form. Consistency concept. All right. So this means that when you are looking at the financial statement, we should be able to compare over a period of time. All right. By the time you start accounting proper, you will see that, okay, for depreciation, for example, there are many methods of calculating depreciation. So if you have chosen a particular method, you have to keep on using it. Accounting policies must be consistent. All right. IES 8, you have to use accounting policies consistently. Okay, so this year you use one accounting policy, another year you use another accounting policy. How do we compare the result over a period of time? So that is what consistency concept is talking about separate determination concept. All right, this concept allows the user to look at the assets, liability, income, and expenditure, and to know the reported figure is the total value for each of these elements. What this is saying is that accounting discourages netting, set off. Say, okay, we are owing them 500,000. They are owing us 700,000. So record in the book 200,000. They are owing us 200,000. That's not accounting. Okay, because you have modeled up the picture. Fine, it is true. The net effect is 200,000. Okay, 200,000 receivable, but you will not have given the true picture to the users of the financial statement. So record separately, all right, that they are owing you 700,000 and that you are owing them 500,000. Report it separately. That is what separate determination concept is talking about. You cannot match asset and liability and say, okay, the net asset, you are now reporting net asset. You didn't know the total asset, you didn't know the total liability. We're just saying net asset. Okay, so it is not encouraged in financial reporting. Okay, so that is basically what we have here in Unit 3. Very, very important for understanding the fundamentals of accounting. So I will be publishing the Unit 4 very soon. If you have not yet subscribed to this channel, kindly do so. Thank you.